Alright, so first of all, we continue with macro investing. It's actually fundamental macro analysis. Roughly, I don't know, maybe 3 weeks, 3.5 weeks. Macro fundamentals. Essentially, we'll go through a whole bunch of charts and kind of look at them and see, as I have been reading literature on macro investing, what other folks do in the real world. Now let's take a quick look on, what is it, go to stock charts. It's probably, yes, stockcharts.com. Let's take a look at what happens when the markets recently. So let's pull up first what? USD. Alright, let's do the USD. It's already there. See what really happened recently, as we didn't have effectively for what, 10-15 days, right? So, yeah, let's try, yeah, no, it's more like a year chart. More like a year chart. 700 is good, yes. So, let's take a look and see what happened. I think F11 would kind of blow out the screen for you. So, first thing you see is, while you guys were vacationing over the last, 10 days, dollar crashed nicely over here. It went all the way down to 73. You also see now that this here, the MACD, is going deep into negative territory, reaching some previous lows. So this looks like a very good, meaningful, and because of extremely oversold condition, a meaningful intermediate bottom. So now I would say the working hypothesis is that this would represent an intermediate low, possibly a short-term low, and would expect some decent correction, maybe as we have here close to the 50-day, or if it's an intermediate correction somewhere in the 66, 76, 77 area. So that is the expectation of a meaningful means probably anywhere from 3 weeks to 3 months that it will hold. Actually, today I had a great confirmation that this would be a bottom. Again, talking about gold bubble, talking about oil. I had a terrific experience. I was in the other office. So walked in, we had this office of Elana. You know what's Elana? That's a Bulgarian financial brokerage. And I walk in as a potential customer and ask him, of course, about investing in commodities, gold, oil, and what's the answer, do you think? The answer was, well, we don't know. I mean, guys, can I actually take a position in, let's say, wheat? I mean, wheat's been going up. We can't really tell you. And then I'm, probing and say, well, what do you mean? They say, well, our office is a year old, and over the last year, for all of 2007, you're the first person asking. All right? So, nobody ever bothered to ask, and of course they didn't even bother to figure out. So, they had no clue anything about commodities. Well, I asked them, well, what about currencies? They said, sure, oh yeah, we got a lot of people there trading. And I'm asking, so what are they most trading? Well, now they're trading euro against the dollar. And of course, the next question is, so how do they bet? Well, now they're all betting on the euro, and all of them wonder if 155 will hold. Let's pull out the euro because it's relevant to what I'm talking about. So now they all wonder if the 155 will hold or it's going to break through. So you have some common, ordinary people now eager to bet. And here's the key. On a phenomenal leverage, 30 to 1, 50 to 1 leverage. It's a huge leverage. I mean, 2% move wipes you out completely. And their concern is 155 is going to hold or it's going to break through and go further. Well, wait a minute. It was 144 a month ago. How the heck now it goes to 155? That's already a huge move. Meaning, for the dollar, it's a phenomenal crash in 1 month. And now they're all concerned and actually beginning to bet. Well, this is, guys, the perfect contrarian indicator when common ordinary people start playing with leverage and after a month-long rise begin to bet on the euro on a further dollar drop. Then you know you have reached a meaningful short-term bottom, possibly. Well, for the euro will be short-term top, for the dollar will be bottom. Well, the question is there a good chance that this is a long-term top for the euro, respectively bottom for the dollar? Is there a good chance? Well, the answer is no. Well, that's what I think, for a good reason. We haven't started talking yet about switching our dollar accounts into euro. You see, 155 has not inflicted tremendous pain to the point where everyone's jumping out of the dollar and switching over to euro. Meaning, stable, solid institutions like ours, this is not yet painful. But for the small fish, they're eager. So what this tells me is that this is by all means a short-term peak for the euro, possibly, likely an intermediate, but by no means the end of the falling dollar. Again, dollar's got to fall more and more and more, and when we get to talk again that it's time that we gotta dump the dollar and switch over to the euro, then you're gonna get another meaningful bottom, but not yet. All right, is this now understanding how to think in a contrarian way? That's the way to think about it, okay? So, let's see what else. WTIC will be we got a WTIC. Well, you see what's happening here. From a low of 85 in February, you're getting to 109 today or yesterday. Let's see, high 108.45, 107. So that's a phenomenal move over here. Again, above the 50-day moving average. And again, above the 100. You see the 100 3 times in a row? It finally broke through. So, what we would expect now, not yet completely overbought, maybe a little more overbought, maybe all the way to 110, again maybe, and then we would expect a pullback. And if we expect a pullback, what is the working hypothesis for a support? What's the working hypothesis? Yes, 100. This 99-100 range, which held 3 times as the resistance, would be a good, proper working hypothesis for a pullback to 100. So that's a nice way to think about it. Now let's try Dow Jones, which is DJIA. See what happens with Dow Jones. Yesterday there was a major, and I mean major, relief rally. You can see Dow Jones rallied 400 from more or less oversold position. So ran up all the way, and here's what you should notice. Over here you got a zone around 1800. You have a zone of, when the first market fell big time, you see from here all the way to here, 11,800 is roughly a decent support. It is not likely that it will break through on the first time. If it breaks through on the first time and falls further into 11,000, so that would be extremely, and I mean extremely damaging for the market. So what is likely is yesterday is a relief rally. What it does, it's called, there's a special name, it's called suckers rally. That's how it's called in Wall Street in technical analysis. To make people believe that, okay, this is a meaningful bottom and we're back to normal. Well, number one, 50-day is going down. So, not yet. Number two, you just barely had the 200-day moving the way up and now it's down. So, you have a 200-day down, a 50-day down, you have the price below or underneath both of them. For all practical purposes, it is safe to say that the bear market has barely begun. Again, this is the bear market that the four people on the round table were talking about, expecting it to begin in 2005 and maybe even bottom in 2006. And it went a lot longer, but finally it's materializing. Okay? Question there was.
Oh, I heard that recently the Federal Reserve spent $200 billion to support Wall Street.
Yeah. Spending is a terrible word because the only thing that Fed does is print. All right, that's the only way. Now, in economics, people understand printing as ugly. They understand that printing brings disaster. It always is in history. So we have a much nicer word in English. How do we call it? Monetizing. So the Fed is monetizing, meaning buying out assets and paying out with, of course, cash. In their cases, reserves, electronic. So yes, they did. 200, yes. So this has got to tell you how disastrous the situation is if they've been pumping and pumping and pumping, right, for what, 9 months now? And now they gotta go all the way to 200,000. Well, guess what? This is amazing. We were having a discussion with the Dar, and she's a leading Keynesian. I'm on the other side, a leading Austrian. But when you get an Austrian and a Keynesian to agree completely on something, it's probably right, okay? And she would told me, these guys are getting crazy. They're beginning to monetize everything. So her opinion was that this was a total disaster of monetary policy. Never before in American history, and typical of third world country, all right? So, today's article was, the Fed goes the Havana way, or the Fed is now behaving like a Cuba's central bank. I mean, even in Bulgaria we don't do these kind of things. I mean, we're a backward country, but our bankers understand, you gotta understand. You guys do this in Albania? No, I wouldn't think. Now, here is the greatest joke. Bob Mugabe. Do you know who's Bob Mugabe? Who?
President of Zimbabwe.
President of Zimbabwe. You know what he did? He extended invitation to Ben Bernanke to teach at the University of Harare and to observe firsthand the devastating effects of the policies that he is currently implementing. Well, Bob Mugabe is a professor. He's got, I think, graduate from Oxford. Of course, he's 70, 80 years old now. So he's got the degrees and everything. But he's probably the most experienced man today in the world on printing money. All right? So he has extended an invitation to Ben Bernanke that, he should come teach to Harare and experience it firsthand and be able to communicate with all great monetary scholars and also see, by the way, given the monetary policies that he is implementing now in the US, he can see far into the future what, this type of policies lead, all right? So where I was I? All right, so this is a sucker's rally, typical, and usually it is designed to relieve anxiety in pressure, short-term anxiety. Again, it is designed not to make people jump. All right, let's pause here. Boiling frogs. Do you know how to boil a frog? You ever heard the story? You get a frog and try to boil it. When you throw it in super hot water, you know what happens? The frog just jumps out. But if you get the frog inside the cold water and slowly warm up and warm up and warm up, in a couple hours the frog will get cooked without even realizing it. So if you just raise slowly but steadily, it actually won't jump. This is the same thing here with the market. The investors are the frogs that are being cooked in or during the bear market, and the market should not under any circumstances fall big time to scare the suckers out of the market. Moreover, those that aren't scared here or here, now suckers rarely means it suckers them or sucks them back into the market because there is still a lot more to lose. Different way of saying is the bear market has barely started, so the losses are barely beginning to pile up, and they need those suckers to sustain the losses. Otherwise, who else will sustain the losses? You got to understand, the market's falling, someone's losing. So who's going to be the loser? Well, that's the idea. Let's see what else we're going to look at. Look, let's take a look at gold, of course. Gold. So a major run from 900 all the way to 975. This is short-term, high-level consolidation from the beginning of March all the way to today's 13th of, what is today? 12th of March. So for 12 days, it is consolidating with a mean or average of 975. It is trying to push through 100, but it is being held. Commercial banks or bullion banks are trying to hold it because they fear that the breakout of the psychological 1000 will have a major effect. Well, for all purposes, that won't be the case. If no one is still asking about gold, apparently 1000 is way too early to wake up the masses. Now, remember what I showed you and read from the Wall Street Journal, that now barely professionals wake up to the idea of investing in gold. In other words, gold's gone up already 4 times. And just now, professionals are beginning to understand, well, at least see that gold's gone up, and beginning to take small positions in gold. So what you need is that these professionals get fully loaded, meaning they are fully invested. It would take another 3 to 5 years, and gold will be by then at 3,000, 5,000, depends on a lot on how weak the dollar is, and only then the masses will wake up. Again, remember what I was telling you a couple of lectures ago. Bull market in gold started in what, 67, 68, and the masses woke up in 78, 10 years later. So now we're only 7 years into the bull market. No one's even bothering to ask, all right? So way too early. What else? TNX, that will be the 10-year bond. So what you see here is skyrocketing. Well, we saw oil, skyrocketing gold. Of course, wheat is now the best performer, and you also see the TNX, that's the 10-year yield, falling, all right? This means one big thing. It means that someone here is dead wrong. It is either that the bond market going on the way down is dead wrong, or commodity and currency markets are dead wrong. You understand that you can't have a collapsing currency, skyrocketing commodities. This certainly implies building inflationary expectations, and inflationary expectations must necessarily lead to rising, here's the key word, nominal interest rates. And yet they have been falling and falling and falling. So you got, I don't know, $10 trillion bond market. You got a trillion, well more than $1 trillion commodity market. You got a $10 trillion currency market. This is a great example, as you're seeing it real time, that the whole concept of perfect markets, the whole concept of rational markets, this is nonsense. This is junk. You see, for months and months and months, the markets are totally inconsistent. Each is worth trillions of dollars, and if someone is telling you the markets are rational, you know, be careful. They're not. I mean, you can't have at the same time gold and oil skyrocketing, and yet, you know, yields, long bond yields totally collapsing. And here is the key: under or less than the official inflation. Official inflation now is in the U.S. what, 4.25 roughly, and yields 3. You know how these bonds were called late in the late 70s? They had a name. They're called certificates of confiscation. Because investing in a bond is a sure way to lose a big chunk of your money, at least the purchasing power, right? Nominally, you're going to get it. You're not going to lose nominally. You're going to get your interest, what it is. But in the end, when you try the purchasing power of your 1,000, and 10 years later, with all the accumulated interest, 1,200 or 1,500, whatever you had, the purchasing power is way, way less. For 10 years back then, what was the approximate loss of purchasing power in dollars? Anybody? Roughly? Dollars lost from 1970 to 2000. That's a good way to think about it. 10 times. 10 times. So from 70 to 80, dollars lost roughly 3 to 4 times its value, meaning it was buying 3 to 4 times less. And now, since then, from 80 to 2004-05, it's lost roughly 3 times. So 3 times 3, roughly 10 times, is a good way to think about it. So this is a sure way to lose money. All right. Let's move on. What else we have to look at? Let's try and go open another window. Let's get back to the Nikkei. Let's see what happens with these markets. NIKKEI, right? Oh, NIKKEI. See, there has been, and this is a perfect. I mean, it doesn't get better for teaching technical analysis. A perfect pullback here to the 50-day. Major collapse, and then a perfect pullback, just kissing the 50-day moving average, and then falling off a cliff, right? So this is a perfect example. So is there a way to go, or this is more or less like the bottom? Well, the working hypothesis now, as of today, is that there is more room to fall. Why? Far from oversold. You have an oversold here, another here, another here. Yeah, it could fall another 1,000 before it goes into oversold. Well, what about here? One bottom here, one bottom here, one bottom here. Too early. It has barely started falling, all right? So, from that point of view, the yen isn't quite, not the yen, the Nikkei isn't quite at the bottom yet. Plus, you just barely got this support level broken. Well, probably very meaningful break down. So it's probably got to go quite a bit, probably to 12,000 or even less. Oh, while we're at it, let me try pull up another one in Financial Sense. Guys, I got a very nice article in Financial Sense. Did somebody see that? Notice it? And oh, there you have it. Scroll to the right the page. There you have it. Expect Japanese hard landing for 2008. New commentary from me. That's my second article that is featured on this top website. Well, how do we know this is the best website? Well, one way to know is you simply scroll down and actually look at who the, all the guys are. Who are these? I mean, these are all top guys. I can start discussing this if you wish. I mean, these are some of the great thinkers. Of course, I'd be somewhere down here in the contributors section. Let's see. Am I showing up here? Yeah. Yes, I'm showing up here. So that's also what makes the site great. So apparently the Japanese have been reading for the last 2 days my article on expect a hard landing. So I'm just saying, hey, this is what the big picture is. This is what the macroeconomy, taking a look from the macroeconomy, mostly from an Austrian point of view, as it is, of course, the preferred way to look at things, at least in the investment world. Oh, this reminds me of something else. All right, so more fun. Casey Research. You guys got to get that Doug Casey guy. We can probably type up here a new tab, of course. Casey, K-A-S-E-Y, Casey. With C, my mistake, with C. CaseyResearch.com. Doug Casey is a legend, one of the best, and I mean he's traveling all the good stuff. You guys have to listen to his interview on Financial Sense for Jim Puplawa. That's this guy. Well, he's got a little older than that. That's probably an old picture. Looks fairly. He's a great guy. He's one of the best thinkers of our time. He's traveled around. He's got great views, highly respected, all the good stuff, a bunch of these. So I get contacted by Casey Research for writing research for him. And I said, sure, no problem, all the good stuff and everything else. And the response is, well, but we don't really want that academic type research. The academic type research doesn't fly. We don't want it. I mean, for all practical purposes, it's kind of like worthless. And I say, oh, no, I did the kind of research like Doug Casey. Well, I hope. And they said, okay, this is exactly the kind of research. So when they checked out my 2 articles on Japan, and the previous one was on Europe, try back FSO editorials, scroll to the bottom, and you'll see here archived editorials. There is expect Eurozone hard landing for 2008, and essentially what I'm saying there, hey, this is what, if you can go and click, no big deal. You can say, hey, this is what some of the major institutions are talking about. OECD, what the ECB forecast is, what the Euro Commission is saying. And then I said, well, I basically think they're getting it wrong because they are underestimating a whole bunch of things. And I'm just saying, hey, these are the 10 things which I think they all underestimate one at a time. So, then Casey Research guys, Lewis, comes back and says, oh great, we're interested in. This is exactly the kind of research we're looking for, and of course, preferably from an Austrian point of view. And the other point of view, 99 out of 100 have the other point of view, all right? So, where was I? Back to, well, stories, NIKKEI. So, apparently the Japanese have been reading my article and getting worried and scared, and by the way, probably selling it. Let's try the Shanghai SEC. No, double S. This won't come up. Yes, click back, double S, SSEC. See what's happening in China. Well, if you would remember, I was showing you a wild bubble from 1,000 roaring all the way to 6,000. Mania Well, guess what's happening? Well, from 6,000, first leg down, recovery. Second major leg down to 42.50. Another recovery. And now the market is breaking again. What else? Well, the 50-day is been going down. Second, it crossed the 200-day. And it also is pulling back now that this 200-day is beginning to reverse or move down. What this is telling me basically is that this looks like the beginning of a bear market. Given how protracted and extended the bull market was, this is the beginning of a major and possibly even secular bear market in China, all right, in the Chinese stock market. So now what will be a very good, so it's going to fall a little bit to about 4,000, maybe a little more. It's going to hit another oversold, and then it's going to rally back, and it's going to rally back probably to around the 50-day moving average, and it's going to start falling back and back. That's at least the working hypothesis. I mean, I can't read the future, but that's the intelligent guess.
Oh, I was watching that video with Jim Rogers.
Oh, okay. What?
Well, his suggestion was that people should start investing in Japan, in yen.
Okay. So yes, I have also written it very carefully at the bottom of my article. It is what I see is that the Nikkei is very vulnerable, just breaking out new lows. But there is a whole different story between the Nikkei, which is the stock market, and the yen, which is the currency. Now, Jim Rogers, I think, and also Mark Faber mentioned that Japanese small caps might be a good buy. What is a small cap, just to be sure you guys understand? Anybody? Small cap? Yes, they have a small capitalization under, I don't know, billion, maybe under 100 million. So the capitalization, well, what is a capitalization? Let's be sure that...
Price multiplied by the outstanding
shares. Okay, so this is the number of outstanding shares multiplied by their price. So this is the market capitalization of the company. In other words, this is the value that the stock market provides to the company. Alright, so yes, he's saying, and yes, the reason is that there is a, well, has been for many years, a yen carry trade. Yen carry trade, as I've been explaining in the other course, you short the yen, meaning you borrow the yen, you sell it, you create effectively a synthetic short. Now, the estimated numbers are roughly between 500 billion and $1 trillion. Well, I don't want to get into that. And sooner or later, this yen carry trade must unwind. Unwinding means that whatever is bought outside the Japan, like Europe and the US, has to be sold and liquidated, and the yen bought back and then used to pay back the bank from which it was borrowed. So there is a phenomenal potential for the yen to unwind. Well, it has actually been unwinding for quite some time. Let's pull out the Japanese yen, which is XJY. Yes, you got it. And see what happens. Well, you can see that over here at 81 it bottomed. That is more or less corresponding with the beginning of the credit crunch. We kind of have like the unofficial date of the credit crunch is August 9th, and you can see it has been steadily rallying. Now is roughly 102 yen for the dollar, and the yen has kept rising and rising and rising against the dollar. I mean, if you remember last time we looked at it, it hasn't been rising steadily against gold, but nonetheless, it's a good, solid rise. So yes, it's absolutely true, but the fundamentals of the yen are radically different from the fundamentals of the whole stock market. And sometimes there may be some sort of divergence. Actually, if you remember the chart, for all intents and purposes since July, the yen has been rallying. And if you remember the previous chart, the Nikkei has been steadily falling back. So a rallying yen has actually hurt the Japanese stock market, at least for the last 9 months. Again, I can get to explain and justify, but I don't want to do this now. So, do we have anything else to see, or we get back to our fundamentals? What's our fundamentals? Alright, well, let's see, silver, SPX. Alright, let's try VIX, the VIX. The VIX is the volatility index. It is derived out of the premiums on options. It indicates the implied volatility by options and is a measure of the risk or of the fear perceived on the market. When the VIX is low, the market is not fearful. We call it complacent. Market participants are complacent. As the VIX steadily rises, this implies a lot of buying of calls and puts. It indicates that the market fear is steadily rising. Well, here it hasn't been rising yet. So, for all intents and purposes, when the market, I'm talking now the stock market, has a major, meaningful bottom, the VIX usually spikes, like it has spiked here. Well, this is the August 9th day, where, you know, the markets went totally crazy. But it hasn't really spiked here for the last 2 days. And if the VIX hasn't spiked, this means that the fear hasn't gone to extreme. I mean, the way to think from a contrarian point is that only if you get the extreme fear or optimism or enthusiasm, only then you have a meaningful, longer term, or at least intermediate, reversal. Well, the VIX tells me there hasn't been any fear in the stock market at all. For all practical purposes, there hasn't been no spike. So, for all practical purposes, this low that we were looking like 4 or 5 charts ago has not yet quite, is not a real meaningful bottom. Meaning it's just a short-term rally, and then it's going to keep on going until the fear rises and the VIX spikes all the way high. God knows, 40, maybe 50, maybe more. All right, let's see. Anything else before we get to some questions? Any questions, guys? All right, so 400, right? Supposed to be fun too. All right, let's move back to investment charts. And well, let's kind of start from the beginning and see what we have here. I think usually these type of charts, this is kind of like the signature of one of the top guys called Gary Dorsch. Gary Dorsch is giving us a fairly nice connection between crude lights and at least in terms of oil prices. And these are at least this here, the US dollar index. Well, he's also showing you the 2-year Treasury note yield. So, what is visible? Again, now, we are making a complete shift from technical analysis to macro analysis. We're looking now at what might be called intermarket analysis. You got commodities, of course, crude, gold will be the other alternative. You also got the dollar, which is a currency market, and you got the bond market. And you see, of course, it just takes common sense. Of course, no econometrics is needed for this kind of stuff to see that as the yield falls and brings less and yes, the dollar falls naturally. Alright? So, you got a fairly decent correlation between lower and lower yield and lower dollar. And then you see like a mirror image that the lower the dollar, the higher the crude oil prices. So that's an important macro relationship. This should tell you that as long as you're seeing these long yields, remember I was talking about the TNX, which was the 10-year yield, keep falling and falling and falling, it's a decent expectation that the dollar will keep falling and falling, and the crude and very likely gold will keep rising and rising. Now, the way it's sometimes called is crude and crude and gold are like Siamese twins. Did I tell you this last time? You know what Siamese twins? Yeah. All right. Thanks God. Let's move on. I think you can just push the down button, or possibly, again, very important so that you don't get any ideas. This is not a systematic presentation. I mean, they come in alphabetical order mostly, so I'll be jumping around, but I'll be trying to help you see the bigger picture. Oh, okay, so this is core consumer prices with CS. Anybody? CS? Anybody? Bonuses? No candidates. Keynes-Shiller Home Price Index. Alright, or OER. What is OER, guys? Nobody's teaching you this?
It's written, owner's equivalent.
Thank God! At least you literate guys can read, sure. Owner's equivalent rent. Can anyone tell the difference? What is what and why we need both? And what's this got to do with consumer prices? Anybody? Any ideas? Well, the answer is shockingly simple. I mean, this is the typical answer. This is the investigative mode that you gotta switch to. As the real estate prices started rising and rising and rising and switching to a bubble mode. And of course, you have to have housing in the price index, meaning in CPI as in inflation, because people do live in houses and they do consume houses. 10-15% increases in housings, let's say, think of it, 15%. And what is the average spending on housing in Bulgaria or in the US, roughly? Roughly. Come on, guys. You don't sleep in houses, your parents?
What, like, is a mortgage or rent or?
Well, as an expense, somehow. Whether it's rent or a mortgage, it's got to be more or less the same. Well, let's throw a rough number. A third of income. A third of income. Is that okay? Would you guys agree a third of income? Yeah, whether it's a rent or whether it's a mortgage, a third of the income seems reasonable. So, houses go by 15%, and that's 1/3 of your consumer basket. What does it mean for the inflation, for consumer inflation? What's the inflation if everything else was zero? 5%, yes, that's it. Well, no bonus point for that multiplication. You just multiply or take 1/3 of 15%, 5. So, whatever the other inflation is, out of housing you gotta add 5%. Well, what would happen if it was actually computed that way? Well, 1 or 2% inflation suddenly will shift to 6-8% inflation. This will be a disaster, total disaster for the bond market. All right? You report 6-7% inflation. So the owner's equivalent rent is the fruit of the imagination of a highly skilled economist to replace the price of a house with something else so as to artificially reduce the CPI. Well, Why would they want to reduce the CPI? One of the many reasons is that the government has to index all Social Security and other expenditures, government expenditures, to CPI. You can see it can index them to 2%, or it can index them to 7%. If you gotta increase Social Security and other costs, which by law have to be indexed to CPI, that will be a complete disaster to the budget, government budget anyway. Well, it's bad as it is anyway. I mean, the deficit's like $600 billion. That doesn't count Afghanistan, that doesn't count Iraq, that doesn't count what else? It doesn't count. The Social Security surpluses, right? So they're all not counted. So the real deficit is 700 or 800. And if you gotta increase by the real CPI, $1 trillion isn't gonna be enough. $1 trillion deficit, right? So the government cannot afford it. So now you gotta make up something. Well, they say, well, let's take a look and we'll take owner's equivalent rent. This means that they take the rent, whatever the market rent is, but because the market rents are going up, why would they be going up? Well, because of general inflation, all right? Because incomes are rising. They provide the owner's equivalent of it, and they adjust the rent for size. They say, oh, now apartments are 15% bigger than 10 years ago. So if the rent went up by 10%, they will deflate it for square footage and higher quality of the house. The idea is that ultimately the inflation is CPI is distorted so as to be politically correct, 2%, all right? So what the guy is now telling is with the OER is the blue, with the owner's equivalent rent. See how beautiful it is, stable in around 2%. Why is it so stable? The answer is simple, because it is designed to be, because it is wanted. The answer is make it around 2%, and they make up the owner's equivalent component so as to report it around 2%. You know, it's artificial smoothing, right? If they were actually counting for houses, oh Jesus. You see, these guys were actually did the computation I was making up like 2 minutes ago. Rather than reporting 2%, during the wild real estate boom, you would have to be reporting 7%. What that would mean is that by using the owner equivalent rent, the government is successfully underreporting inflation by roughly 5%. Well, what a miracle, because I took more or less a realistic number for real estate price increases. And of course, I took a realistic number for the share of home or housing expenditures in the household budget. So it's not a wonder, it's just a good design that 1/3 of 15% increase will be 5%. So the point to understand is you can crank out all the most sophisticated econometrics in the whole world. You crank it out with that these distorted numbers, you're going to get plain nothing, and your analysis will be 110% worthless. There is a saying in econometrics and modeling, what is that called? How do we call this type of modeling? Guys, have you guys studied econometrics? What is the GOGO or GOGO model saying? You know, GOGO, GOGO, let's write this out. We gotta know what this. This is, in econometrics, garbage in, garbage out. So, as long as your data is garbage, you may run the wildest, most sophisticated error correction models, VAR with adjustments and all the great stuff, adjusting for autocorrelations and heteroscedasticity. You plug in this garbage, there's one thing guaranteed in the world. You ain't gonna get good stuff out, all right? It's gonna be, whatever it is, still garbage. So, the real-time investment analysis is not cranking out the next correlation, is trying, I mean, that's the real art, is trying to figure out what the distortions are, to provide an estimate for the distortions. Again, you're third, fourth year. If you guys got good data, and that's extremely hard to get these days in economics, you run projects. Any third-year student, meaning a junior or senior, can show it up and run the regression and make a nice analysis. All right? You understand my point? A senior or junior can easily do that. That's the easy part. That's the college part. The real economic analysis is knowing where the numbers are wrong, why they're wrong, what is wrong with them, what is the number that is wrong, make the adjustments, and then begin to do what you're about to do. You understand that part? Does it make sense? Is it logical? I mean, I understand it might, sound a little, despairing for some of you. So we started all of this stuff and data is bad. Well, you gotta understand the basics, the fundamentals, and the principles anyway. But the hard part is to understand which of the data look right and are probably right, and which of the data are wrong, and what's wrong with them, and then to provide your corrections, and then do what you intend to do. Alright, so you can see now that this is going this way, and guess what? When housing was rising, everyone was clamoring to use the owner equivalent rent because in order to get the low inflation. Now you can guess everyone is clamoring to get rid of the owner's equivalent rent and use real housing prices because housing prices are going down. So you always have the bias to underreport inflation. And that bias is inherent in Wall Street because it's eager to report a lower inflation, in the government, in general in the economists, and most importantly with politicians. So, for every single group out there has the strong incentive to underreport inflation. Well, who's the only group that isn't? Well, ordinary common people who actually live in houses and actually gotta buy the house, all right? Is that guys fairly clear? All right, let's move on and see what's next. All right, that's probably the same chart. Again, different corrections. I don't want to get into this. Job creation and home prices. All right. This is what is called the concept which Doug Nolan talking about. Well, that's the other course anyway. The bubble economy. Bubble economy means that when the bubble is created and keeps growing and growing, it gets to distort the macroeconomy itself. How? As you have real estate prices going up, you also have non-farm payrolls going up. In other words, the bubble, when it's blowing, creates jobs, and when it's bursting, jobs are getting lost. So, when the bubble begins to affect employment, then you know that you have a bubble economy, meaning the investment bubble is beginning to create distortions in the real economy. So that's one example of it. Let's move on and see what else. Alright, so this is, I don't know if we had it probably with it, crude light, you see, from 90 all the way to 2000, if you like, to 99. It was more or less flat, and now you got a major bull market. I don't have to talk a lot more about crude oil. I've already done enough. Alright, so this is Dow Jones Industrials versus gold. You see, this is a completely different different way to look at things. This is how some people look at it. I don't see who actually published this one. What you see here is different zones representing, I would guess, different years. So this represents one range of period from 99 to 2002. Then this represents the next range, another. So you see on the one hand, you have the Dow Jones. On the other, you have gold. Well, when Dow Jones and gold are positively correlated, what does it mean? What is the macroeconomic interpretation? What is? It simply means that inflation is driving both. Inflation is driving gold higher, and at the same time, inflation is driving Dow Jones. So if Dow Jones is not collapsing, but holding steady around 12, 14,000, it may be simply because there is such a strong inflation that rather than Dow Jones fall 15%, you inflate the money supply, the monetary aggregate by 15%, and Dow Jones stays steady. Next year, it's got to fall another 15-20%. You inflate 15-20%, and Dow Jones stays steady. Well, this is exactly what we've had for the last 6 or 7 years. Actually, Dow Jones, when measured in terms of, again, oil, copper, wheat, whatever, any standard commodity, Dow Jones has been falling and falling and falling. In real terms, but in nominal terms, it has been staying flat. So this is one way to think about it. All right, let's move on and see what's next. All right, so household surplus or deficit is a percentage of GDP. Gee, I don't remember what was that surplus about. Is it savings? What is this? PCE. PCs, well, consumer indices. Guys, I don't remember what this surplus is, but whatever it is, you're saying that something big is happening. I just have forgotten what this chart is about. All right, so you see, it's going here, right after here, some negative during the Great Depression. That's the key here. Great Depression, 32, 31, 32 is kind of like the bottom of the Great Depression. It turns negative, and you see now it is turning negative again. So whatever it's telling you is not bad. It's a percentage of GDP. I can't tell. Let's move on. All right. In the shadow of an unregulated market. All right. This is good for my other 400 level course, but you might as well get to hear this. Credit default insurance market. This is better known as credit default swap market. This is also known as bond insurance. The monoliners that are blowing up and that are desperate for some sort of a government or other bailout. You can see a market of close to zero and a couple of trillion up until 2003 has gone, and this is what Doug Nolan has been talking about, totally parabolic throughout the years. I'm talking about last 4 or 5 years. It's totally gone up parabolic to 45 trillion. All right? So, it simply means that when the credit, this is default insurance on bonds and loans, if these bonds and loans get a little bit shaken, then a 45 trillion market is going to be in deep, deep trouble. Well, it already is, meaning it already has been in trouble since August 9th. And until these positions are unwound, it will be all pain. Alright? So, for US stock market, you have derivatives, and you can see the derivatives here rising to 21 trillion. You also have mortgage security markets and US Treasury markets. Well, what is the point to understand here? What is the big macro picture? The big macro picture is that derivatives have come to dominate the the financial markets. In other words, it doesn't matter anymore the US Treasury market. US Treasury market has become tiny and so far relatively insignificant within the scope of the US financial system. Now, there is one more which is not on the picture, that's a little, at least to me, surprising, and these are the so-called interest rate swaps or interest rate derivatives. So these are derivatives on defaults of debt. Well, there are separate derivatives on the direction of interest rates. They are a lot more than these. And because interest rates have been going down and down and down for 2.5 decades, they haven't blown up. Meaning, when interest rates start going up, suddenly everybody that wrote these interest rate derivatives are going to blow up one after another. So, that's another big crunch and problem in the waiting. But the point here is, hey, this has become from a tiny little dwarf to a major monster, all right? And what matters today is actually what's happening here and not here or here. Now, this is also important. In mortgages, mortgage security market has gone to roughly 10 trillion. That's a different story altogether. Any questions here? So, interest rate derivatives missing, they're a lot higher. It's a whole different story. Maybe some other course. Yeah, well, apparently this is the dilemma. Well, that's a joke. You understand who this guy is, right? Alright, so everybody's got to know who this guy is. He's got a problem. Either inflation's, he's kind of hold between inflation, which is steadily rising, and the dollar on the precipice of collapse, right? So just, and I said that apparently this was New York Times, I don't know, that's what New York Times is worth, because someone's sending me emails about an article in New York Times, and usually that's not good for articles, but good for, stuff like that. Alright, so, annual holding gains on residential real estate and disposable personal income. Oh, okay. This is a terrific macro picture. It shows you the performance, annual performance of real estate. How much time we got? 2 minutes? Is it? Alright, so we'll finish with this and you guys will be gone. So, first of all, you see what's been going on here. And 65, and that's got to be 66, it's the same old story, guys, at least for those that have been with my courses. The takeoff of real estate here is associated with what? The rise of the welfare warfare state. Meaning suddenly the US government is beginning to inflate like hell. Of course, this weakens the dollar. Of course, those of you that know, well, somehow, maybe in my international finance course from last year, this is the time where gold, which has been trading in 35, suddenly begins to take off and diverge so that you get this two-tier gold market. So, gold's 35 stable, and suddenly in 66, 67, or 68, gold on the black market, is actually on the London market, starts taking off, showing phenomenal inflationary pressures, alright? So even though governmentally it's fixed at 35, and the US government will exchange it to other governments at 35, gold is just taking off and rallying to 60, 70, 80, and 90. Well, what does it mean, 60, 70 bucks for gold? Well, it means it was 35 and going to 70. Gold doubled in a few short years, at least on the exchange. Well, if gold doubled, it wasn't apparently for nothing. It was for some sort of inflation pressure. Well, this is where the inflation pressures are surfacing. They are surfacing in a major technology bubble back then in the late 60s, just like there was one in the 90s. Back then in the 60s it was new economy, which of course wasn't a new economy because there was a new economy in the 20s, all right? But that's what inflation does to people's thinking. And inflation usually does brain damage. It distorts thinking, people's thinking. So the point is, you see here, now what's this here? Well, that's the 73, 74 oil shock, which also represented a major recession in the US. Well, at that time, real estate didn't perform, meaning returns were close to zero. Well, 70s were characterized by phenomenal inflation. They were stagflationary, all right? So you see wild run-ups in housing, 12, 16, 20% returns on housing. Housing was the greatest investment in the 70s. Well, at least until 78, right? Because from 78, housing was replaced with gold and silver. And up until then, everyone, 78. You see now, 78 to 79, everybody was investing in real estate. Well, was real estate a great investment? Of course, no, it wasn't. Yeah, just because it gave 15% doesn't mean the return is great. I mean, you go to Zimbabwe, housing returns $1 million, but bread is going up 2 million%. So when you measure your house in terms of bread, or gasoline, or electricity, or other stuff, housing was not keeping up with inflation. Is that fairly clear? That's a fairly good indicator of what inflation was. Okay? I think okay. All right. Any other questions, guys? Well, you can ask now or later. Let's get down. These are straight